Hello there, I'm your host Leelaa Rao, welcoming you to your fortnightly program Invest Wisely, your ultimate gateway to safe and intelligent investing. Coming up in this session, annuity investing, understanding the cost behind the fine print. You make a fortune on the headline and then the fine print takes it all away. Well, you can consider this as a joke or rather the reality on annuity investing. Let's explore the truth behind this. Following that, strategies for underperforming annuities and recourse for investors. Can you dump those underperforming annuities or cash out for your urgent needs? Let's see some ways to do this. And also, what is your recourse when you feel you are duped? Finally, in question time, we will discuss some interesting emails from investors. Annuity investing, understanding the cost behind the fine print. Well, there are more myths surrounding this investment class than any other form. I'm sure most of you with some money to put aside have at some point in time thought of investing in annuities, or the scenario is you have been approached by a salesperson or financial advisor trying to sell you this. But for sure, this is an investment that is very easy to get into, but all said and done, very difficult to get out of without paying one form of a penalty or the other. Now, what is this annuity? By definition, an annuity is a contract between the investor and the insurance company. There are various types of annuities, such as a single premium deferred annuity, an immediate annuity, a variable annuity, an index annuity, and a tax-sheltered annuity. Depending upon the type of annuity, the type of guarantee given by the insurance company would vary. Briefly, let's see what each of these annuities mean in simple English. A single premium deferred annuity allows you to make a single premium or lump sum towards a policy, and the taxes are deferred or postponed until the money is withdrawn. It is a contract between you and an insurance company guaranteeing you a specific interest rate for a specific period of time. Now, it's also possible to buy a single premium immediate annuity. Here you make a lump sum payment to the insurance company which guarantees you immediate fixed income for the rest of your life, and in some cases continuing for a certain period to your beneficiaries even after your death. Sounds too good, but what's the catch? You must sign over all the money you have deposited in the annuity to the insurance company with full knowledge, and you will never be able to touch it again apart from receiving the monthly income. That is single premium annuity in simple words. Variable annuities are commonly called mutual funds with an insurance wrapper. It is a two-in-one package sold by an insurance company combining the characteristics of a fixed annuity with the benefits of owning mutual funds. You purchase a variable annuity contract by making either a single purchase payment or a series of purchase payments. A variable annuity offers a range of investment options. The value of your investment as a variable annuity owner will depend on the performance of the investment options you choose. The investment options for a variable annuity are typically mutual funds that invest in stocks, bonds, money market instruments, or even some combination of the three. You could allocate any percentage you want among the available funds. For example, you could allocate 40% to the equity-based funds and the rest of the 60% to fixed income-based funds. It is your choice. So it's extremely important for you to avail the prospectus of the underlying mutual funds and thoroughly study them before you commit your funds. Now, an index annuity is a contract with an insurance company for a specific period of time. The surrender period of an index annuity is usually about 7 to 10 years. The index annuity tracks an index such as the S&P 500 index, and your return on your money will usually be a percentage of what that particular index did for that corresponding investment year. Coming to the essential topic of the day, let us now concentrate at the costs or charges that are hidden in annuity investing. I am going to take the example of variable annuity to explain these charges or costs involved. Well, all annuities come with one form of cost or the other. Quite naturally, these charges will not only reduce the value of the return of your investment, but also more often decrease your investment principal as well. The most common of these charges are the following. Surrender charges. if you withdraw money from a variable annuity within a certain period after a purchase payment, typically within 6 to 8 years, but sometimes as long as 10 years, the insurance company will usually assess a surrender charge, which is a type of sales charge. This charge is used to pay your financial advisor or broker a commission for selling the variable annuity to you. Generally, the surrender charge is a percentage of the amount withdrawn and declines gradually over a period of several years, known as the surrender period. For example, a 7% charge might apply in the first year after a purchase payment, 6% in the second year, 5% in the third year, and so on until the 8th year when the surrender charge no longer applies. Often, contracts will allow you to withdraw part of your account value each year, that is 10% or 15% of your account value, without paying a surrender charge. Let us take an example. You purchase a variable annuity contract with a $20,000 purchase payment. The contract has a schedule of surrender charges beginning with the 8% charge in the first year and declining 1% each year. In addition, you are allowed to withdraw 10% of your contract value each year free of surrender charges. In the first year, you decide to withdraw $10,000 or 1/2 of your contract value of $20,000. Here, we are assuming that your contract value has not increased or decreased because of investment performance. In this case, you could withdraw $2,000, that is 10% of the contract value, free of surrender charges. But on the rest of the sum withdrawn, that is $8,000, you would pay a surrender charge of 8% or $640. The second of these charges is mortality and expense risk charge. This charge is equal to a certain percentage of your account value, typically around 1.25% per year. This charge compensates the insurance company for insurance risks that it assumes under the annuity contract. Profit from the mortality and expense risk charge is sometimes used to pay commissions to your financial professional for selling your variable annuity to you. For example, your variable annuity charges a mortality and expense risk charge at an annual rate of 1.25% of account value, and your average account value is $50,000. So, here you will pay $625 in mortality and expense risk charge that year. Next comes administrative fees. The insurer may deduct charges to cover record keeping and other administrative expenses. This may be charged as a flat account maintenance fee of $25 or $30 per annum or as a percentage of your account value. For example, your variable annuity charges administrative fees at an annual rate of 0.15% of account value. Your average account value during that year is $100,000. You will pay $150 in administrative fees. Then there are underlying fund expenses. Here you will also indirectly pay the fees and expenses imposed by mutual funds that are underlying investment options for your variable annuity. Further, you will have to pay fees and charges for other features. These are special features offered by some variable annuities such as stepped-up death benefit, a guaranteed minimum income benefit, or long-term care insurance, and these often carry additional fees and charges. Some insurance companies are now enticing investors by offering variable annuity contracts with bonus credit features. These contracts promise to add a bonus to your contract value based on a specified percentage, normally ranging from 1% to 5% of purchase payments. For example, you purchase a variable annuity contract that offers a bonus credit of 5% on each purchase payment. You make a purchase payment of $10,000. The insurance company issuing the contract adds a bonus of $500 to your account. But is there any free lunch offered, especially in the world of money? Never. So here's a catch. Variable annuities with bonus credits may carry higher expenses that can far outweigh the bonus credits offered. Quite often, you will be charged for bonus credits offered in one or more of the following ways. First of all, the surrender charges may be higher for a variable annuity that pays you a bonus credit than for a similar contract with no bonus credit. Secondly, the purchase payments may be subject to surrender charges for a longer period than they would be under similar contract with no bonus credit. Thirdly, higher annual mortality and expense risk charges may be deducted for a variable annuity that pays you a bonus credit. Although the difference may seem small, over time it can add up. In addition, some contracts may impose a separate fee specially to pay for the bonus credit. Before purchasing a variable annuity with a bonus credit, ask your financial professional who is trying to sell you the contract whether the bonus is worth more to you than any increased charges you will pay for the bonus. Here you also need to consider the other features of the annuity to determine whether it's a good investment for you. Apart from all the charges I discussed earlier, other charges such as initial sales loads or fees for transferring part of your account from one investment option to another may also apply. It is very important that before you invest, you ask your financial professional right at the onset to explain to you all the charges that may apply. You can also find a description of the charges in the prospectus for any variable annuity that you are considering, and you must make it a point to read the fine prints. When we come back after a short break, we will look at the various options that are available for your underperforming annuity. And if you feel you need to lodge a complaint against any fraudulent or misleading actions, we will look at the venues for this as well. Stay tuned. Invest Wisely will be shortly back after the break.